Peter, great to have you back, buddy.
Hey
How
Dale,
are you?
thanks for having me.
All right, so let's start with what we were talking about, and I caught you on CNBC, and the question was, what were your thoughts of the NFP? And you said it was clear as mud. So why don't you tell us about the mud part? We know about the, headline stuff.
Well, you had the household survey had a population adjustment made to it. If you take out that population adjustment, instead of adding like north of 900,000 in the household survey, only 84,000 were added.
Okay.
On the same day that the BLS said 517,000 jobs were created, the S&P Global Services Index, covering the service sector, of course, said that hiring has basically stopped to a halt. And the ISM manufacturing number was 50 on the dot, and I'm sorry, in the services number. So nothing pointed to this huge increase in payrolls outside of that establishment survey. So there could be some quirky seasonal adjustments. I mean, that are related to it, and I wouldn't be surprised if February jobs number was a minus, just to sort of average out a lower trend in the pace of hiring.
Okay. Kind of hard to argue with the technicals on the 10-year. Where do you think it'll stall out?
Interestingly, the 10-year literally got to its 200-day moving average of 333 to 334 last week, and bounced on it like magic.
Yeah, right here it is.
Yeah. So you had this strange rally last Thursday in global bonds and a massive rally in Europe after the ECB meeting, which was strange because the ECB was pretty hawkish, but yields are right back up again in Europe because we've gotten a slew of hawkish commentary even today, as the markets basically have been easing right and running over these central banks who are still trying to tighten. And I think we're just getting a reminder from central banks that markets don't get carried away here.
Okay, can you foresee that the reminder from central banks can take us back to the 435 level or so, or is this going to have trouble up here, say about 380, 390? You have a view on that?
I have a lot of trouble trying to figure out on a fundamental basis where the 10-year goes from here, because on one hand, I can argue that the U.S. economy is in a recession or about to start one. Therefore, the 10-year should go to 3. But then on the other hand, I think inflation is going to be very sticky, even though there's no doubt that it's rolling over. And I'm still very uncertain about how the Bank of Japan, when Kuroda hands over the keys to somebody else, even if it could be the deputy governor, which has a very similar thought process as him, rates are going up in Japan. They are going to widen yield curve control. They are going to, at some point this year, get out of negative interest rates. Yeah. And I don't know how the Japanese bond market's going to handle that. Therefore,
it's okay.
And that's going to have a big influence on U.S. rates. And the ECB is beginning QT soon. And we'll have to see how the European bond market handles that, because if we're all in this boat together. I mean, look at today. Yields are jumping today. Yes, on the heels of Friday's number, but it's also following what's going on in Europe. So we're very intertwined in where we go. So anybody who tells me where they think the 10-year is going to go and are basing their analysis on just where they think U.S. inflation and growth is going to be, I say, okay, I get it, but what happens if the BOJ loses control of the JGB market? What happens if the ECB loses control of the European bond market? And how is the U.S. going to handle a ton of supply coming this year? At the same time, the Fed is essentially selling treasuries. Foreigner central banks are selling treasuries.
Who are the buyers, Peter, on the long end? Who are the buyers?
Well, you have now pension funds that are buyers. I mean, you have plenty of individuals now that are saying, wow, I want to own treasuries.
Yeah, that's right.
Look what I can get. So, there's domestic money that's going into it. So I just think it's real tough. I mean, I want to say that the 10-year goes to 4, Again, not for good reason. Not for good reason.
Okay.
It's not because the economy is going to be good. Economy is going into recession.
Yeah,
but we can
which
still go to
is
4%
kind
for
of
bad
a
reason.
very toxic cocktail.
Yes.
If rates are going to new highs and while the economy is weakening at the same time, I've never seen that in my career.
That would be a tough situation. I agree.
Okay.
But
I
look,
know another
we
big.
yeah.
Go ahead. Go ahead. Did you want?
No, I mean we have the Fed who keeps raising interest rates in the face of a slowing economy. So you got that too.
Yeah. So I know another big theme you're talking about is the reopening in China, which is going to be very supportive in your view of commodity prices. And you still, even like oil, we could talk about the metals, but energy's been under pressure after this recovery. And here we are. Maybe you're going to make another great call because let me remind you, you probably don't even remember, but last time you were on, I said, we were talking about long silver, and you said, and I said, well, we need, we need a bear market in the dollar, and you said, well, maybe the euro will turn. That was here, and then you came on, and silver was pressing this $18 level down here, and you said, oh, it's a head and shoulders bottom, and that was perfect. So maybe we're entering kind of a similar period here in energy, because I believe that energy is cheap compared to where it was a year ago. You like it here?
If you look at China, China's got 17% of the world's population.
Yeah.
That has essentially been locked up for 3 years.
Yeah.
And now they're no longer locked up. So in 2022, China saw a reduction in the barrels of oil they purchased on average on a daily basis for the first time since 1990. In 2023, I expect the daily demand for crude oil to go to a record high. So just by reopening, and why should we think their reopening is going to be different than ours here or in Europe or the rest of the world? They're going back out again. Just by going to work, just by getting into your car, just by traveling again. I mean, just imagine what the demand for jet fuel is going to do as the year progresses, as the Chinese tourist starts to travel again. I mean, in 2019, the Chinese tourist spent $250 billion a year. That number essentially went to zero. A third of the tourists that visited Japan came from China. A quarter to Thailand came from China. Those numbers went to zero. So I think that the just by going back to your everyday life is going to lead to a substantial rise in demand for oil out of China. Now, there will be some offsets. I mean, if the U.S. economy slows, we'll see some reduced demand here. But this is all coming in still the context of still supply challenges that I think are big picture. But I think that the China reopening is going to lead to a rather notable increase in the demand for oil and products, and should lead to higher prices.
Okay, and
as the year progresses.
And the SPR release is over, and now we're talking, what's part of it, but maybe China was a bigger part of this decline from 120 in WTI. So now we actually need to restock the SPR, and China's reopening could be something. I think there's one more low coming, but I am looking at oils. I think it's going to be a great buying opportunity, maybe mid-60s.
I'm still trying to figure out why the Department of Energy hasn't started buying back barrels. I mean, they're sitting there at $70 as on the bid side. And what happens if we don't get there?
Yeah.
What happens if we go back to 80 to 90 to 100 and the DOE hasn't bought back one barrel?
They're trading like rookies, because
they had a great short, and now they're trying to get cute with the cover.
Yeah, well, yeah, right. And also, do you know how many times I've seen people have limit orders in the market, and it wasn't a big deal if they had just gone to the market instead of waiting for their price, and they end up missing the trade because they were penny wise and pound foolish. And yeah, I agree. They're doing the same thing here.
Seems
So
to be.
yeah. You have a comment on this recent pullback in metals? I assume you think that this is an opportunity to add to longs.
Well, we know the dollar rally from January through October of last year ended up being really just an interest rate differential thing.
Yeah.
And nothing more, because once the market started to sniff out the Fed was toning down the rate of increases, the dollar rally stopped dead in its tracks, and when coinciding with inflation slowing down. So here you have the ECB that's going to raise another 50, and again just beginning QT, and that dollar rally, obviously, as I said, was over once the Fed started to slow down their rate increases. Now we're getting, after the sell-off subsequent to that, we're getting a little bounce in the dollar. But I think if all it was interest rate differential thing, then the dollar rally is pretty much exhausted its catalysts. And so I think the trend will be down again. I think at some point it'll be interesting to see whether sort of the big picture flaws and challenges for the dollar, that being, rising U.S. debts and deficits, particularly the budget deficit, which is essentially entering a recession already at 5.5% of GDP, whether that creates downward pressure on the dollar as the year progresses, which I think is a high possibility. So, gold and silver have had a nice run, as you mentioned, since October. And, gold was approaching 2,000. Yeah. And now we're probably got overbought, and it saw its pullback of note on Friday on that jobs number. But I think after the pullback, we'll see buying. The World Gold Council came out with their 2022 report last week, and we saw near record buying by central banks. Yeah. Central bank buying is now a constant, particularly after the U.S. and the EU sanctioning the Russian central bank, and I expect that bid to be pretty persistent.
Okay. I think 1810 would be a good level. A lot of things pointing towards, maybe to get an emotional push under 1800, but, don't try and be perfect and scale in. Is that what you would tell your subscribers and clients? Scale in on the decline?
Yeah, I mean, we're long, and we're not, any new money we get, we're not trying to get cute here. We still believe that there's a lot of upside.
Okay. Anything else top of mind that you want to cover, Peter? I mean, I think we've covered the board.
I think it's important to really focus on earnings season. That we still have more to go in the next couple of weeks with what we've seen so far. I mean, the markets. I understand the markets rally in January. When you think about, the two biggest headaches for the market in 2022 was 40-year highs in inflation and the most aggressive monetary tightening in 40 years. And then as we got to sort of September, October, November, inflation started to roll over and the Fed started to slow down its hikes. So you sort of relieved those two headaches. And the market, had its January rally on that. But I don't think that we're done here in terms of curing headaches, because the new headache is what's the economic consequences of higher rates for longer and an earnings recession, which we're now upon. That's the next challenge for the market. And the S&P trading at 19 times optimistic earnings, we're back to a situation where there's not much room for error. And if rates are going to stay high for a while, which I think they will, I just think that we have another battle on our hands in terms with the stock market, and that's the economy and earnings.
And that could be the catalyst for taking out the October lows sometime this year.
It could be, yes.
Okay. And you talk about the earnings recession. They're buying every bad earnings that comes in. You get these gap lower moves overnight and into the morning, and they're buying those dips. Do you think it's still Pavlov's dogs? I mean, it's working for them, and that buy the dip. It's working right now.
Yeah, the market wants to party like it's 2021. They want to believe that we're somehow going to go back to this world of 1 to 2% inflation and easy Fed. And it's just, we're not going back there. I think people just need to let it go. So I understand that, you know, when you have like 30 years of a Fed put built into people's psychology, and the thought that, okay, the Fed is going to take their boot off my neck, therefore it's time to buy stocks. Well, the Fed has not taken their boot off your neck, the neck being inflation. They may stop pressing down, but that foot's going to be there. So I think people just need to be careful of, like, this Pavlovian response to central banks. These guys are going to stay tight. Their credibility has been shredded over the last couple of years, and they're not going to let it go. I mean, Powell's legacy is not going to be determined by where the S&P 500 or credit spreads go from here. His legacy is going to be determined by was he Arthur Burns or not, and he knows it.
Okay, yeah. All right. Do you remember a book like in the 70s called Crisis Investing, Doug Casey?
I know Doug Casey. I know the book.
Okay,
yes, I met him a few times.
Okay. When I talked to him, he said that the bull market in gold will end when there's a cover of, you know, maybe it'll be Barron's or some other financial rag that has a gold bull, you know, a bull made in gold, ripping up the stock market and tearing up stocks. And that'll probably be the high of the mania in gold. And then he'll buy Berkshire Hathaway after that. So
I can't argue with that.
Yeah. So we got a long way to go in this gold bull market. I think it's embryonic. Plus you have all these charts, right, Peter, where it showed the gold to stock ratio, gold to bank share ratio. They're all breaking down in favor of gold.
I mean, gold to the Fed balance sheet, central bank balance sheets. I mean, when you think about the gold price today relative to the peak in 2011 at $1,900, you know, there was no such thing as negative and zero interest rates in 2011.
Right.
Now, granted, the dollar was weaker then, which tells you that if the dollar just starts to weaken, that could just be enough to get you going again.
Right.
So we'll see.
All right. Well, always appreciate your views, buddy. Follow you.
Yeah, I appreciate having me on.
Yeah, follow you all the time and turn the volume up when I see you on TV.
Great. I appreciate it. Thanks so much.
Peter Boockvar, everyone. You could follow him at Boockvar on Twitter, and go read his stuff on his website. It's Bleakley, right?
Bleakley is the wealth management business that I'm the CIO of. The actual newsletter is Book Report, the Book Report, but the website is Book Report, BOOCK report.com.
What's a minimum account that you accept at Bleakley?
We have about 60 different financial advisors, so it ranges.
Okay. So reach out if you probably never a more important time to have management. You can't just buy the SPY and be a genius anymore. Good to have pros on your side. Thank you, Peter.
All right. Thanks, Dale.
Have a great year, buddy, and I'll be in touch with you.
Sounds good.
Okay. All right. Peter Boockvar, everyone. And you could join the team in 25 minutes on the Morning Edge. Remember, don't just count your pips, count your blessings. We'll see everyone for Turnaround Tuesday. Adios.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.